Let's face it, this year has been quite shocking. The S&P 500 is down as much as 20% year to date. And with the massive craze of S&P 500 covered call ETFs, I wanted to benchmark the SPY, which is the gold standard, versus three of the top or most talked about S&P 500 covered call ETFs, and to see which one is providing a better return, or is just investing in the SPY the best return that you can make in this kind of downturn. So if you like the sound of this, all I ask for is that you smash that like button and don't forget to subscribe. So what we're going to do is a back test on 4 ETFs. So the benchmark is, as I mentioned, the SPY, which is tracks the S&P 500 top 500 stocks in the US. And the backtest period that I'm going with is January the whole of 2021 and 2022 year to date. And the reason why I'm doing this is in 2021 we had a massive bull run, which is great. So I'm expecting to see all the portfolios up in 2021. And then we've had this massive, as I mentioned, as lows of around 20% year to date in 2022. So I want to understand which of these three covered call ETFs, which I'll go into, do they perform better than the S&P 500? Are they more volatile? What is the best thing for your portfolio based on your goals that you are trying to achieve? So there are two tests we're going to run. The first one is we start with 100,000, and with these three covered call ETFs, they all provide dividends. So we're going to reinvest the dividends back into each one of these portfolios. And then the second one is we're not going to reinvest the dividends to see if it makes any difference to the actual outcome. So the three covered call S&P 500 ETFs are as follows. The first one is XYLD. So XYLD is a Global X S&P 500 covered call ETF, which is currently paying, at the time of recording, a yearly dividend of 9.38%. And the way it does this is that it sells at the money covered calls of the S&P 500 of 100% of its portfolio. And if the shares get called away with the remaining, it will then sell another at the money covered call. So it does this every single month. Now, XYLG is the same thing, but what it does, it does 50% of its portfolio doing covered calls, and the other 50% is left there to, hopefully appreciate in value over time. So XYLD is 100%. XYLG is 50% covered call. And when we look at the back test, the way to kind of remember it is you've got the GR, which stands for growth. So that is 50% of its portfolio writes covered calls, and this one is 100% of its portfolio writes covered calls at the money. And then we've got the third ETF, which is JEPI, so the JPMorgan Equity Premium ETF. And what this does is it invests in low volatile S&P 500 stocks, whereas the others cover the whole S&P 500. The JPMorgan Equity Premium Income ETF does low volatility S&P 500 stocks, and it also writes covered calls as well. It's not the full amount. I don't know the exact percentage. If you do know that, please comment down below. But as a result, it pays a less dividend of 6.39%. So the aim of this fund is to ride the wave of the S&P 500, but obviously take into account the volatility as well, and to smooth out those returns for a more smoother ride, so to speak. And again, as I said, we're benchmarking this versus the S&P 500. So we're looking at 2021, 2022, and then we'll be looking at this combined period to date. So the first back test is the dividend reinvesting. So I'm using Portfolio Visualizer. So just so you guys know, we are looking at January 2021 till May 2022. We're starting with the 100,000, and we've got dividends reinvested, and then we've got portfolio one, which is XYLD, which is 100% covered calls on the S&P 500, XYLG, which is 50% covered calls, 50% saved for growth, and then you've got JEPI, which is low volatile S&P 500 stocks, as well as covered calls on that. So we've got 100% of those portfolios against those three assets. And what we can see in terms of the results, if we look at the combined period from January 2021 till May 2022, you can see here that all four portfolios effectively are up during that period. With the most interesting one is that the JPMorgan Premium Income, so JEPI, with the highest return of 10.55%, with the S&P 500 being second, and then not much between both of the full covered call and 50% covered call ETFs. And the bit I find really interesting on this is, from a max drawdown perspective. So the ETF with the less volatility has provided the best returns, right, across 2021 and 2022 year to date. Now, that's important to bear in mind when you actually look at the breakdown between 2021 and 2022. But overall, what I find really interesting is that JEPI has outperformed the S&P 500 across both years so far, with the least drawdown, which I think is absolutely immense. So when you actually break it down from a year perspective, so as you would imagine with the bull run, it is quite straightforward that the S&P 500 would have provided the best return. The second best return is obviously going to be XYLG, because you've got 50% of the portfolio on covered calls and 50% saved for growth. And in a bull run, when you have that growth, you're going to get the best return. Interestingly enough, is you got the next one again is JEPI, and then lastly is XYLD with 100% doing covered calls. They're all up, but these are kind of interesting. Now in 2022, this is where, in my opinion, that JEPI really comes into its own. It got the third highest performance in 21, but in 22, it is the best performer. So all the S&P 500 ETFs are down, which is to be expected, right? Currently the S&P 500 is down 12%, which is the most, but JEPI is the least. Is the best performer with the least drawdowns of 5.14%, which is what gives it the overall growth across 2021 and 2022 year to date, because of its performance during there. And as you can see, the S&P 500 really comes into its own during bull runs, and then in bear runs again, it's not the worst performer, but you can see this is where JEPI really kind of takes into its own there, which I find absolutely fantastic. And then if you look at it from an income perspective across the three funds, as expected, JEPI is going to be the least performer. But then this is where you get your balance between income versus growth, right? So even though we've provided the least income, it's the least volatile and also producing growth at the same time. So overall, if you are dollar cost averaging, and again, this is just my own opinion, not financial advice. If you're dollar cost averaging in your 20s or your 30s, putting X amount a month into an ETF, it's probably best to stick it in the S&P 500, right? However, if you are worried about volatility or have anything along those lines, JEPI is probably a better move for you because of the lower volatility to really achieve pretty much the same or even better results. I think over the long term, as you see in 2021, because the S&P 500 goes up over the long term, I think over a 3, 5, 10, 15 year period, the SPY will outperform JEPI, assuming you are reinvesting incomes, dividends as well. over the long term. But if volatility and worried about seeing massive down days, recession potentially occurring, JEPI is probably the way forward. Personally, I would avoid XYLD and XYLG. The only reason is, and again, there's a lot of research on YouTube videos on this. Over the long term, the principal growth you're going to get, even though you're getting 8-9% dividends, is not worth it. You'd rather go into something like JEPI, which is a lower dividend of 6%, which is still a really, really good monthly dividend of around 6% currently year to date. And the growth as well of the S&P 500, right? So that would be my view. And then lastly, looking at it from a dividends reinvesting point of view, so you can see here we had 112, 115. Overall, the S&P 500, as you would imagine, did perform a lot better than everything else. But you can see that JEPI was still second. It was still positive, unlike XYLD and XYLG. XYLG is up slightly, but XYLD is actually down, right? So if you are utilizing the dividends for income, your principal is actually declining if you're using XYLD. XYLG, you're pretty much flat, but you're still up 2.92%. It's not as good as inflation, don't get me wrong, but over the long term, if you are utilizing covered call ETFs as part of a balanced portfolio for income, this is something, again, over the long term that is there. And this is why, again, I would recommend, if you're dollar cost averaging and not even looking at your portfolio, SPY is still the better option for you over the long term. If you are cautious of volatility, you can even see here on Max Drawdown, it's still the least volatile of the 3 ETFs that we're looking at. And even if you're including the benchmark, it's still the best performing in terms of drawdown and the second performing in terms of returns. So you can't, in my view, you can't beat that. I'm not saying you put all your money into JEPI, but at least a portion of your portfolio if you're a dividend investor, JEPI is something I would strongly consider, because during market downturns it performs the best, and during market upturns it performs okay. It's not the best as the S&P 500, but it performs okay. So that would be my kind of view on this, looking at this outcome of this back test. Again, all portfolios work very, very well during bull runs. S&P 500 works the best, followed by JEPI. And in downturns, where this is where I think JEPI comes into its own. So I would strongly consider looking at JEPI. Do your own research. Has a dividend against it as well, which is great if that's something that you're looking for as part of a balanced portfolio. So I really hope you like this back test. If there's another covered call ETFs or NASDAQ ETFs you want me to look at, comment down below. I can have a look at that for you, and I shall see you guys in the next video.